I recently saved a business owner over $400,000 in taxes by focusing on just 3 simple tax strategies, and today you're going to learn those as I rank my top 5 strategies for business owners. My name is Sherman, I'm a licensed CPA, and my clients have already saved over $6.3 million in taxes so far this year at mycpacoach.com, and today you are going to learn them for free, so please do me a favor and hit the like button for me below, and let's jump right in. Okay, so coming in at strategy number 5 is going to be entity optimization. Simply choosing how you want your business to be taxed can result in tens of thousands of dollars in tax savings. You can choose to be taxed as a C corporation, an S corporation, as a partnership, or sole proprietorship. And here's the thing, in almost every scenario, one of these options will save you more money in taxes than the other ones presented here. Yet 90% of business owners fail to make any tax election with the IRS, literally subjecting themselves to more taxes most of the time, like the additional 15.3% self-employment tax, for example. Now, most people do not even notice that they pay this tax on their tax return. And if you want to check this out, just look at line 23 of your 1040. But what you need to understand is this. If you earn active income through a business and you are not taxed as either an S corporation or a C corporation, you will pay a 15.3% self-employment tax on up to about $176,000 of your self-employment income, plus another 2.9 to 3.8% on all of your self-employment income beyond that level. When your business is earning over $50,000 in net income after all deductions, an S corporation can be highly beneficial, and in some cases, a C corporation can be the best option for you as well, depending on the circumstances. And this is just a simple example. There are many more ways to create tax savings by splitting your income into multiple entities, like management companies, holding companies, different partnerships, and so on, that may allow you to take advantage of the unique tax benefits associated with these various entity types. So if you're looking to create big tax savings, optimizing your entity would usually be where I would start. Now, coming in at strategy number 4 is converting your personal expenses into legitimate business deductions. Now, generally speaking, personal expenses are not tax deductible. However, if you are able to associate a legitimate business purpose with your expenses, they can be. Now, what we want to do here is look at all of your current expenses and look for ways to legitimately qualify those expenses as business deductions under Section 162 of the Internal Revenue Code. And I would look at everything from your housing expenses, your dining expenses, transportation costs, travel, education expenses, childcare, and so on. And just to illustrate this, here are a few examples of how you can turn these expenses into tax deductions. So if you use a portion of your personal residence exclusively for your business, like an office space, garage space, or some type of space, you can deduct a portion of all of your home expenses through your business. If you own a car, but you use that car for your business in some way, shape, or form, you may be able to write off a portion of all of your car expenses under your business. The same thing applies to business travel and business meals. If there is a legitimate business purpose for the expense and a business contact involved, you may be able to legally write off those types of expenses through your business. But that's not even it, not even close. Even if you pay for things like education expenses, like college tuition, courses, licenses, and so on, and that education is required to conduct your business, you may be able to write off all related expenses. If you pay for health insurance premiums out of your own pockets, then you can deduct the portion you pay as a legitimate business expense if the business owner is on that policy. Now, with this strategy, we're not looking to spend more money to reduce our taxes, but the opposite. We're looking at money we're already spending and seeing if there's any way to legitimately deduct those expenses through our business. And you can take this even further by tying in strategy number 3, tax-free reimbursement plans. So as a business owner, you have the ability to set up benefit plans through your business for all of your employees. But here's the good part. Since you're self-employed, you can structure benefit plans that you also personally benefit from while deducting the cost of those plans from your business. And if you just so happen to have little to no employees in your business, then that gives you even more room to be more aggressive here. So let's cover a few of the big ones, like an HRA or health reimbursement arrangement. This is a plan that allows you to reimburse yourself for any of your out-of-pocket medical expenses. For instance, I once had a client who was going through some stuff medically, and those expenses were going to cost her over $50,000 personally, and it was not covered by her insurance. But we were able to deduct 100% of those expenses through her business by setting up an HRA for her through a C Corp, which allowed the business to reimburse her for those expenses while also deducting the expense as well. Another big one is the Dependent Care Assistance Plan. This plan allows you to reimburse yourself for child care expenses, up to a certain amount anyway. I have clients who have children in daycare and other programs, and they pay for those types of expenses out of pocket. And many times they are able to set up a plan like this through their business, which allows the business to reimburse them for some of that cost while they write that off and reduce their tax exposure at the same time. And then there's accountable plans. These plans allows your business to reimburse you for almost any business related expense without the expense being taxable to you. For example, let's say you have home office expenses, meal expenses, car expenses, or even cell phone expenses that you are paying for personally, not through the business. Well, an accountable plan would allow the business to pay you for those expenses while deducting those amounts. And the amount you receive from this reimbursement would be tax-free to you if structured correctly. Now, I will say that most of these benefit plans strictly apply to either S or C corporations, so you will want to carefully evaluate your business entity before attempting to set up anything like this. Also, all of these plans must be in writing and are subject to various tax rules and regulations, so be sure to do your research or get a CPA involved to help you with this. Now let's move on to strategy number 2, income shifting strategies. One of the beauties of owning a business is the ability to shift income to places where the income is taxed at a lower rate or sometimes not taxed at all. So let's put yourself in this diagram and say you have $500,000 of income that you do not want to pay tax on. And let's look at some different buckets that you can shift this income into to reduce your taxes. Like bucket number 1, yourself, when it is tax deductible and tax-free to you anyway. You may be able to make tax-free payments to yourself from the business, just like what we saw with the reimbursement plans that we talked about. You can also use strategies like the Augusta rule, for instance, which allows you to make tax-free payments to yourself from the business when renting your personal residence to it. And remember, all of these payments are tax deductible for the business, which also reduces your taxes at the same time. And then there's bucket number 2, your family. If you happen to have family members with little to no income, shifting income to them would reduce the taxes you would have to pay at your higher tax bracket and would allow that income to flow through to them who would be in a lower tax bracket. Plus, with a standard deduction, it is possible that the income they receive could even be tax-free to them. Now, we see people do this all the time with their children or parents if their parents do not work and they financially support them. Now let's move on to bucket number 3, your retirement and health savings. So there are several self-employed retirement plans that could allow you to put up to $70,000 to $300,000 or more towards it in one given year. You can set up a pension plan through your business, a cash balance plan, solo 401k, SEP IRA, HSA, and so many more options. For one of my clients who had enough income to support this, we were able to put up to $600,000 of their income into a cash balance plan by optimizing how they paid themselves and by adding their spouse to the business, which doubled the amount that we could put towards their retirement. And that's just one example, but a lot more can be done here. But let's look at bucket number 4. We also could look at shifting income to various entities. So some entities are subject to lower tax rates altogether, like C corporations, or no taxes at all, like a nonprofit. And when there is a legitimate business purpose, shifting income to either one of these entities can be extremely powerful. For example, one of my clients had plans to buy a business, so we shifted some of their income into a C corporation to allow them to save for it, while having that income tax at just 21% instead of 37%. And since those funds were going to be reinvested at some point, we didn't have to worry about dividend taxes or double taxation here. And in another instance, one of my clients had plans to give money to nonprofits. So we created her own nonprofit, which allowed her to move money over in advance to create very large tax deductions in advance. Now, these types of maneuvers can save hundreds of thousands of dollars in taxes, but this next strategy is literally the king of all tax strategies, and it's not even close. Some taxpayers are able to completely wipe out 100% of their tax liability by implementing this next strategy alone. So let's talk about the number one tax strategy available in the tax code: depreciation. And when I say depreciation, I am referring to every type of depreciation that exists: bonus depreciation, Section 179, cost segregation, straight line, and so on. This is quite literally how billionaires pay little to no taxes at all.
A lot of my write-off was depreciation and other things that Hillary, as a senator, allowed.
Many tax professionals refer to this strategy as the paper loss strategy. Depreciation allows you to show a loss on paper while earning cash flow in reality. And that is because it is a non-cash expense that you can claim or write off against the value of any business or investment property you own that qualifies. And the more property you own, the more depreciation you can take, which literally allows people to trigger more and more depreciation as they buy more property. And the tax code has several provisions that allows taxpayers to take very large amounts of depreciation, sometimes allowing you to write off up to 100% of tangible property that you own. These deductions can then be used to reduce other income you report on your tax return. If the property is used for your business, then those deductions may reduce your business income. If it is a rental property, then those deductions could reduce your rental income and so on. And to trigger the most amount of depreciation, you can use things like bonus depreciation, Section 179, or even a cost segregation study. Plus, there are several more provisions and exceptions in the tax code to do even more with this, like the real estate professional tax status, purchasing short-term rentals, or business use property. But by and large, when maximized, depreciation is the king of all deductions and the holy grail of tax strategy. You can literally buy assets that help you build wealth while triggering these large deductions that offset your taxes, only allowing you to build more wealth. And if you need help implementing a strategy that is guaranteed to reduce your taxes like this, just apply to work with my team of CPAs today at mycpacoach.com.